Hey folks, this is Office Hours with Desiree and Malcolm. This show is intended to peel back the curtain on the home mortgage industry and make the whole process more approachable and more accessible to everyone. Desiree Regusci currently serves as the Business Development Manager for Fortis Mortgage, and among other things, she is responsible for educating current and future clients on the ways in which the right mortgage can help make their home ownership dreams into a reality. Malcolm Ethridge recently began working with the team at Fortis Mortgage as a strategic consultant, where he lends his expertise and perspective as a certified financial planner in helping homeowners with unique and complex borrowing needs understand and navigate the mortgage landscape. In each episode, the pair will discuss a particular mortgage topic, share real-world examples, and give you the perspective of the lender, underwriter, and loan originator. So with that, Desiree, Malcolm, take it away.
Hey folks, thanks for joining us. I'm Malcolm Ethridge, that's Desiree Regusci, and this is Office Hours. And on this episode, we're talking about the advantages and disadvantages of refinancing your home's mortgage. These days, not only are we experiencing record low interest rates, we're also seeing home prices that are constantly on the rise. At least it seems that way, according to Zillow, Redfin, and the other home sourcing websites. And this has created a sort of perfect storm for people wanting to refinance their mortgage for a number of reasons. But although it's obvious to mortgage professionals the reasons why you might want to refinance and reconfigure the terms of your home's mortgage, it's not necessarily as obvious to those outside of the mortgage business. So today, that's what we'll be discussing: the basics of how a refinance works, as well as some scenarios in which a refinance might make sense for you. So before we get started, Desiree, how you doing today?
I'm hanging in there. How are you?
Yeah, I'm good. I'm doing well. So to get us started off, what are some reasons why a person might want to refinance their mortgage in the first place?
Great question. I think the basic ones are to change their rate, right? To change the term of their mortgage. If they won't need to pull out equity, so it's like cash out. And then obviously, if they're in a position to drop off their their private mortgage insurance off of the loan would be another one.
Okay, so let's take those one by one for a second. So a better rate. That's pretty obvious. You know, rates maybe when you bought your house 5 years ago, let's say 10 years ago, whatever, could have been at 4%, 5%, 6%, 7%. You could have been in a different financial position, paid a took it out with a higher interest rate, whatever was going on. Now rates have come down 1 or 2%, and you want to save a few dollars every month by refinancing. So is that what you mean essentially by better rate?
Correct.
Now, better term might cover a whole slew of different things, but what essentially do you mean by, better terms?
Well, maybe not better terms, but changing the term of your mortgage. So we do have a lot of clients that come in and say, okay, my original was a 30-year fix. Now we've been in the home for 5 years. I'm making more money. I want to look at a 15-year fixed or a 20-year, right? They want to pay off that loan faster. So there's an opportunity there to just change the terms of your the schedule.
So maybe my payment is going to be about the same, but I'm going to own the house outright 15 years sooner, 10 years sooner, something like that.
Possibly, depending on what your original rate was. Yeah, absolutely. Or you may only be paying, $100 more, but you just shaved off 7 years of the loan.
So there's something else you mentioned in there, PMI. First define it, right? Jargon alert. And then tell us why I even care to refinance to get rid of PMI. Why would I want to get rid of it?
So your mortgage insurance, right? So if you originally purchased the home with less than 20% down, you're going to have mortgage insurance. So we see a lot of individuals that maybe they purchased 3-4 years ago, but they've gained a ton of equity in this market on their house. So they refinance that. And now once they've refinanced against the value of their home with the base loan amount, now they've dropped below that, 79%. And now they can drop off that monthly mortgage insurance payment. And for some, that could be a couple $100s.
And then the last one you mentioned was cash out, right? I might want to take some cash out of the house, which is one I've heard quite a few times, people saying oh, I refinanced my house. That means I got money back, is the way that people we'll term it, which isn't necessarily the case, right? It's
right.
You shifted it from one side to the other, right? But could you explain a little bit about the cash out and why that might be attractive to some people?
Absolutely. So we have customers that take cash out. The equity in their home affords them the ability to take cash out against that. So, and they use that cash for various reasons. Maybe they want to pay off debts, consolidate those debts. Maybe they need to pay tuition for a child. Maybe they want to use that and put it towards a vacation property. We just talked a lot about that on a previous podcast. So they're able to really use those funds for whatever they need it, to be for. But we could see everything with that. So just a matter of what the client is looking to utilize that for.
Yeah, so that could have been a dumb question. Why would people want cash? Well, for whatever reason we use cash for, right? God knows how much. But one of the ones that you mentioned, I'm hearing more popularly, or more frequently, I should say, than ever, is the cash out to consolidate debt. So people have credit card debt, for example. It's at double-digit interest rates in a lot of cases, and rates right now, maybe they have a 3 handle on them. And so you see the comparison, right? I've got $20,000, say, of credit card debt, where I could refinance, take $20,000 out of the house, and now I'm paying it back over a 30-year period, presumably, right? In some cases. And I'm also paying for it at 3-something% interest versus 15, 18, 22,
20%, right?
Percent.
Exactly.
So that's a very popular one that I'm seeing. And then it probably is always popular, but I'm seeing it more frequently now because, like I said, in a lot of cases, home values are going up because we have this buying frenzy that we've been in for the last year and a half or so, since COVID really kicked off. And it's pushing up the home values of people who aren't even necessarily interested in selling and moving anywhere else anytime soon. But I'm seeing the attitude of, well, I'll get while the getting is good. I will, be strategic here, take a few dollars out of the house with the newly created value in my home, and pay off some debts or whatever else, I might decide to do. And what's interesting about that subsequently is it does also help improve your credit score, which is kind of counterintuitive if you think about it, right? Like, I'm refinancing, and the terms I get in the refi are going to be based on my current credit file. But if I were to do a cash out, take that same $20,000, pay off those credit cards, my credit card debt disappears. So now my credit score has increased, and that's when I would love to be able to refi, when my score is at its all-time high. But I guess you can't have your cake and eat it too, in all worlds. But anyway, so I got kind of off on a tangent on the cash out, but really what I wanted to move to from there is sort of the LTV requirements, the loan to value requirements, right? For a refinance, are they any different from a person who's purchasing a house versus refinancing, or is it going to be about the same?
There are some changes, right? Depending on what type of loan you had, what type of down payment. Again, you could have done a 3.5 or a 3 or a 5% down payment, which, your LTVs would be, would show that. But when you do a rate term refinance, you're going to have a maximum, or you will only be able to have a maximum, I should say, of 90% LTV. If you're going to do a cash out, that's going to be a maximum of 80% LTV. And again, we're just talking about single family primary residences. So keep that in mind. So yeah, the 90 and 80. Again, though, we do have to show, if you're going to do a rate and term refinance, we have to have a change in the rate or a change in the term. So we got to show some value to that somewhere along the way. And so again, if you're working with a mortgage professional, obviously someone who is trustworthy and is going to go through that process with you, they're not going to convince you. We could talk a little bit, I think, later in this about, obviously, is it worth it? Because it's going to cost you money.
Well, I mean, let's talk about that. What about fees? Does it cost me anything to refinance my mortgage?
Of course, right? It's the same process to refinance. It's going to cost you money just like when you purchase. Now, the costs associated may not be as high, but I think I tell when people are going to purchase, for your, for those closing costs, probably stick to around that 2.5% of the value of your loan, right? So same concept for a refinance. Probably plan for about 2.5%. Now, the good news is with a refinance, you're able to build the costs of that refinance into the loan. So if you don't have, if you don't have that 2.5% to do that refinance, you can build that into the loan, making that loan, the base loan is going to go up slightly. But that might be a greater value to somebody in that moment who may be still seeing a reduction in their payment by a couple $100 by doing the refinance.
So is that typical? Is it usually that folks will just roll the closing costs back into the new loan versus taking cash out of their bank account to make it happen?
Honestly, I see both. It's kind of divided. Some folks say, no, I want to pay that at the closing table. And some say, no, I don't want to pay a single cent. I want to roll it all into the loan. So it really depends on the financial situation of each borrower.
Interesting. And also built in there, I know from going through this process with some financial planning clients in the past, that there's going to be a trade-off where the escrow still exists, right? So I've got the escrow on the loan I'm currently in, right? Because these things are paid a year in advance. And then I've got the prepayment of the escrow on the new loan. And a lot of times I've seen where people get freaked out about that and say, well, I'm paying twice, essentially, right? And it's my understanding that what happens is you go into the new escrow, you pay that one a year in advance, and then you get refunded a prorated amount of whatever you haven't used on the other side, the current loan's escrow. Did I say that right?
You said that correct. Yeah. And if there's nothing for that old escrow account to pay out into, then yeah, the money will get refunded from the title company.
So let's shift gears a little bit. Is there a point where it may not make sense to refinance?
Yeah, I mean, absolutely. Right. Again, we just talked about it. There's a couple different things. One, you have to make sure that whatever lender your current mortgage is with, you've reached a period where, I would say a rule of thumb is probably about 6 months. So again, we've mentioned this in a previous podcast. It's not just about time frame. It's usually counting down in days. So call your lender, ask what that that period of time is to where you can go out and refinance the loan. And they'll give you that exact date so that you don't get a prepayment penalty on the loan. So again, may not be worth it if you still have, 120 days left. Another thing is not enough equity in the house, right? Yep. So again, if you, things really just kind of stayed where they were, and then you've been making those payments and maybe it is a year, but the market hasn't increased very much, and you can't get yourself to that 90% loan to value because you started with 3% or something to that extent, then yeah, again, it's probably not going to make sense for you at that time. You need to get a couple more payments and build up that equity a little bit more.
And it sounds like you're leaning toward the phrase I would use called the break-even point, right? So yeah, there's a point at which on that new loan that you took out in the first place to get into the house, right? Or maybe you refinanced already, and it was so recently that you haven't hit the point at which you've broken even on the money that you spent to get that new loan versus reaping the benefits of being in that loan. So your monthly payment, as an example, you mentioned a couple $100 a month savings, right? So maybe you refinanced, you save $200 a month. That's going to get you $2,400 a year, which means you've got to incorporate X amount of years before that $2,400 adds up to whatever it cost you putting into that new mortgage for closing costs and associated fees and all that kind of stuff. Did I say that one properly?
Yeah, you're spot on. So if you're only saving $75, $100 a month, and it's going to take you 7 years to get the return on the investment based off of those closing costs to refinance, I always ask clients, are you going to be in the house in 7 years?
Yeah.
Because if you're not, then it's not worth it, right? We have to make sure that reduction in whatever you're getting towards makes sense. So yeah, I think it's, again, planning, having the conversation, looking at the numbers, making sure that it's right for you.
So let's shift gears once again and
Mhm.
and get into a couple of success stories. I'm sure you've got a ton because everybody's
Mm.
been refinancing these days. But could you share a story or two where, maybe a client came to you complaining about their current monthly payment as an example? We just, got done talking about that, or maybe they didn't realize they had a decent bit of equity in the house already built up in the home, and maybe how you helped educate them on the ways a refi could save them a few dollars every month to make the home more affordable.
Yeah. I would say you're spot on. It's been a lot of refis in the last year, and every single one of them are great. If we're able to help a client reduce their payment and reap the benefits of a lower rate, then that's what makes my job great. I would say the one that comes to mind is I had a client that um, we had started having a conversation about a refinance, and really it was just from this client hearing about the interest rate. She's like, I don't know, should I refinance? It seems like it's a decent amount lower than what I had from 7 years ago, I think, when she had purchased the home.
Mhm.
And, to her surprise, not only was, a refinance going to work, she was able to reduce her payment by over $300 a month,
Wow.
because we were able to drop her mortgage insurance. She had also built, from the time she had purchased the house through the monthly payments and now getting that house appraised, she had gained, I think it was like $240,000 in equity in the house.
Wow.
So it had skyrocketed for her in 7 years. So yeah, there was just a ton of, things that we uncovered through that process. And she was so happy. And this afforded her to save that money, but start investing in her retirement.
Mm.
So it's a really great opportunity for folks who, again, maybe they feel like, and I'm sure you're going to love this, who feel like either I can't save enough at the end of the month, I'm not putting enough into my retirement account. Take a look at where your mortgage currently is, because right now in this market, there may be an opportunity for you to take advantage. And so again, having a conversation isn't going to cost you anything. And so I encourage everybody to try to figure out or take advantage of the rates right now if they can.
I want to stay there for another moment. And I hope this won't insult anybody's intelligence by me spending extra time on this, but I really want to make sure
Yeah.
that this part is abundantly clear, because as I'm hearing you talk, I'm thinking about how many people may not even be aware of this. So we talked about PMI again earlier, mortgage insurance earlier, and a lot of people who have gotten into mortgages where they bought the house with 3% down, 5% down, 10% down, anything less than 20, right?
Mhm.
They have PMI in their loan. How do I know, though, if I'm looking at my statement, whether I'm paying PMI or not?
Well, it's going to depend on the lender. So it'll depend on that mortgage statement. They'll usually have a breakdown, like a statement breakdown at the bottom of the sheet or middle of that sheet, that's going to
Mhm.
show you what your payment includes. So, everything that's going into escrow, what is going into your principal, what's going into your interest. It should tell you what is going into that mortgage insurance payment every month on
And that question was sort of a setup. So here's the
there.
the other side of it. Is it a safe assumption from where you sit that most any person who has mortgage insurance in a loan,
Mhm.
who then crosses that threshold where they've got at least 20% in equity in the house now built in, whether it's through appreciation of the value of the home, or they've made enough monthly payments that they've cut down the principal in that home, or some combination of both. Is it safe to say that any person in that position is a really good candidate to look at refinancing that mortgage to get rid of the PMI, because that's ultimately going to end up reducing your monthly payment just from not having to pay that extra insurance every month?
Oh gosh, yeah, absolutely. I think to though, if you've just made a ton of payments, right? You've been in the home for 10 years. 10 is even a little much. But I would say that if you've been in the home, for a little bit amount of time,
Mhm.
and with the market the way it is, if you think, and you've been looking, we all are on Zillow and Redfin and Realtor.com, looking at all of our neighbors' houses as they're selling. if you feel like maybe over the last 3 years, 4 years, your home has built a lot of equity, it may be worth talking to a mortgage professional about that, because your lender is not keeping track of your equity in your house. They're not keeping track of how much it's worth. So you could have an opportunity where you go in and refinance to drop that off. So I would say absolutely, it is worth exploring. Again, having a conversation doesn't cost you anything. So, but not dropping your mortgage insurance definitely will if you're able to do so.
Awesome. Well, that'll do it for this episode. Thank you, ladies and gentlemen, for joining us for Office Hours. I'm Malcolm Ethridge. She's Desiree Regusci. And Desiree, remind people where they can find you if they want more information after this goes live or just want to get in contact with you.
Yeah, absolutely. So Desiree Regusci on LinkedIn, and you can email me at Desiree@fortismortgage.com.
Awesome.